Chapter 6. So the first module that we will be doing in grade 11 term 2 is partnerships. Partnerships as a type of business enterprise. So up until now we have only looked at the bookkeeping of a sole trader. That's also the most easy or the most simple way of bookkeeping, because we only have one owner who provides all of the capital and therefore is entitled to all of the profits. So there are also other types of businesses. In grade 11 we will do partnerships, and in grade 12 we will do companies. So the business enterprises which does their business in exactly the same way, but where they are not only one owner who provides all the capital and that takes all the risk and therefore not get all the profits. So in this chapter specifically, we will be looking at a new type of business enterprise called a partnership. So a partnership can consist of 2 to 20 owners, or the owners are also called partners. It is important to know that these partners are jointly as well as separately held responsible for the debts of the partnership. Now what this is, what the meaning is of this, and this is very important that you know this concept: jointly and separately held responsible. So let's say, for instance, you are in a partnership and this partnership goes bankrupt and has a lot of debt that the business cannot pay back. So therefore, we cannot get the funds from the business's money. Therefore, we are jointly, so everybody that's in the partnership as partners are jointly then responsible to pay this debt. If it happens that your partner is also unable to pay the debt, then you can also be separately held responsible for the debt. So therefore, there's no such thing that a partnership can go bankrupt and there's no money to pay their debts. I can always then go to the partners' joint personal finances, so their personal house, their personal car, their personal other investments, and go and get the money from there. If they can't, if one of the partners can't, then separately, so there will always be one partner at least that can cover the debt of the business. So it is therefore very important to be able to completely trust the person that you enter the partnership with. Remember, if I cannot trust my partner and he does something that I don't approve of, and the business goes under because of this decision he's made, I will be held jointly and separately responsible for the debt of the partnership. Whether it was my mistake or not, it's irrelevant. I will still be held responsible for the debt. So a partnership is a huge risk when it comes to a form of enterprise. Therefore, the biggest differences between the different types of business enterprises lies in the way in which we obtain our capital, as well as, of course, because we obtain capital from more than one partner or from more than one owner, therefore the way that we then divide or distribute our profits will obviously change. So in the case of a sole trader, the owner is responsible to generate all of the capital, and therefore he can take all of the risk, which also entitles him to all of the profits. This is the reason why he is entitled to all of the profits. So in the case of a partnership, the partners are contributing to the partnership in one way or another. What I mean by that, one way or another, either by giving capital or by giving skills maybe, or some other form of assets, but in one way or another there is a contribution towards the partnership. So this contribution made by each partner will determine which portion of the profit he is entitled to. So not one partner will get all of the profits, obviously. Like in a sole trader, we now need to share our profits, and the sharing of the profits is going to be one of the main calculations in grade 11 in this module, and specifically in the ledger accounts. So pay close attention. So the biggest difference now is there now needs to be a contract between the partners, and that contract we call a partnership agreement. Apart from the normal things that is in a contract, like the name of the business, when the business started, what will be the trading name of the business. Apart from those business-like entries, we also now stipulate certain important things in this partnership agreement relating to the distribution of profits. So let's see. A partnership agreement is drawn up to determine exactly how the profit should be divided amongst the partners. So based on the contributions made by each of the partners, some partners might only contribute to the business by providing capital to the partnership and are no further way involved in the day-to-day activities of the business. Now, such a partner, so one that only contributes capital and doesn't want to be involved in the activities of the business, such a partner we call a silent partner. So they only give money and doesn't want anything more to do with the business except for getting the profits, of course, at the end of the year. So the partnership agreement in this case might stipulate that a portion of the profits can be awarded to these partners in the form of interest on capital. Now, interest on capital is a new concept that you haven't worked with before, and that is literally what it says. So if you put money into the bank in a fixed deposit, you get interest on that money. So the same concept apply to this. If I put capital into the business, I get interest in return for that investment. But this interest, remember, is already a portion of the profits that I am distributing. Another partner might be working full-time in the business, and therefore the partnership agreement might, in this case, state that a portion of the profits can be awarded as a salary to the partner. So this is again a new concept to you. We haven't worked with the salary of a partner yet. It works differently than a salary for a normal employee. Obviously, a salary of the partner is already a part of the portion of the profits. So very importantly, stipulations such as these in the partnership agreement are called primary distributions of profits. So then the remaining profits after this distribution has been deducted will then be further distributed between the partners in the ratio as stated in the partnership agreement. Let's just go to the side and just look at this concept again, because this obviously is a huge part of partnerships that you need to understand. So let's consider the following as an example. After we have established the profit, we see that our net profit works out to be 100,000 Rand. So in the case of a sole trader, that one owner would have gotten all 100,000 Rand. But now in the case of a partnership, this needs to be distributed amongst the partners. So when I distribute, there's two stages of distribution that I need to consider. The first stage is called the primary distribution. And then the second stage is called the final distribution. So this is a very, very important thing to understand. Both the primary distribution and the final distribution comes out of the partnership agreement. So in the partnership agreement, in the contract between the two partners or the three partners or however many partners there are, this contract stipulates how much money each of the partners will get. Now the primary distribution is all the money that they can take already throughout the year, such as, firstly, a salary for the partner. Secondly, they are also maybe entitled to interest on capital. And thirdly, they might have maybe also said, you know what, you can take a bonus as well. So all three of these could be present, or there could only be one present, or there could only be two present. It depends on business to business, their partnership agreement. So what is important is these three primary distributions is already part of my profit distribution. So if I have 100,000 Rand to distribute, then 50,000 is going to the salaries of the partners, for instance. Interest on capital takes another 25,000. Bonus takes another 10,000. Then it means that of this 100,000 throughout the year, I've already given away 85,000 Rand of my profits. Right? So in other words, this is profits that I then cannot distribute as part of my final distribution. These profits are gone already. So therefore, when I go and I do my final distribution of profits at the end of the year, then I need to go and calculate how much profit do I have left. That is the remaining profit. And the remaining profit, exactly what the word says, is the 100,000 minus the final distribution of 85,000. All of the final distributions added together was 85. So therefore the remaining profit is then only the 15,000. And that 15,000 will now be distributed according to my ratio between the partners. So if the ratio is 1:1, everybody would get half of 15,000. If my ratio is according to the capital contributions, then if the one gave 400,000 and the other one only gave 200,000, then the 15,000 would also be divided more to the one and less to the other one. But what you need to understand for now is that the final distribution of profits is only on the remaining profit. Remaining meaning that of that net profit, after salaries have been given, after interest on capital have been given, and after bonus has been given, what is left of my profits, and that will now be shared according to my ratio between the partners. Furthermore, let's do the following comparison between a sole trader and a partnership. Now, we now know that there's only one owner in a sole trader and there were many owners in a partnership. We know that the sole trader provides all the capital, and we know that in a partnership, each of the partners will contribute some form of capital. Now, from grade 10, you must know that owner's equity, the private accounts of the owner, consisted of capital and drawings. Capital being the money invested in the business, drawings being the money that is taken from the business. Now there's two types of capital contribution. There's the initial contribution of money, giving money, but then there's also profits kept in the business. Now for that, let's quickly go and consider the following. At the end of the year, we take all our nominal accounts and we close them off to two final accounts. This is now what we've done in a sole trading business. We used to close them off to trading account and profit and loss account. Final account 1 and final account 2. Now what you must know, or rather what you must remember about the final accounts, is that these two accounts are known as calculation accounts. In other words, they are there to calculate something specific. Once these accounts have calculated what they are intended to calculate, they will close off. So it's not an active account in my books, not at all. Just used to do something, calculate something, then close off again. So what is the trading account supposed to calculate? And what is the profit and loss account supposed to calculate? Now let me tell you. The trading account is supposed to calculate the gross profits. And then the profit and loss account is supposed to calculate my net profits. So in other words, when I now work with my nominal accounts, I will ask myself the question, which of my nominal accounts is going to help me to calculate the gross profit? Because those accounts that's going to help me calculate the gross profit, those accounts will close off to trading account. And then the accounts that's going to help me to calculate the net profit, those ones are going to close off to the profit and loss account. Now, the gross profit is actually very easy. There's only 3 accounts that helps me calculate gross profits. The first account being sales, but then remember, sales would have already had debtors' allowances subtracted from it in the account. If this is very foreign to you, please refer back to what we've done in the grade 10 videos. So sales, and then the other thing that helps me calculate gross profit is cost of sales. So sales minus cost of sales is then going to give me gross profit. So therefore, because I have sales and cost of sales in the one account, I can close this account off, and then the answer that I get is going to be transferred to my profit and loss account. So in other words, the answer that I get here is actually my gross profit calculated. That's not too bad, eh? It's easy to understand. So therefore, what I've calculated is my gross profit, so that is then taken to profit and loss. So in profit and loss, the first entry would say coming from trading account, in other words, the gross profit. Now, what else adds and subtracts from gross profit to give me what I'm aiming for? I'm aiming for the calculation of net profit. There's only 2 things. Gross profit plus any incomes minus any expenses. So I would literally go and add all my income separately to the credit side and all my expenses separately to the debit side. Therefore, gross profit plus incomes minus expenses is going to leave me with exactly what I wanted to calculate, and that is my net profit. Now, in the case of a sole trader, all of my net profit, all of it, belongs to only one guy, and that is the owner. So I'm going to take it to his personal account, which is the capital account. So that's what I wanted to get to. Capital then is the account that keeps the owner's profit as well as the owner's initial capital contribution. Good. So this is 2 important things that you need to have understood and remembered from last year. So in other words, the capital account takes the contributions plus profits. Good. So with that being said, now we can go on and compare a little bit more. In the case then of a partnership, I want to still see the contributions by each partner, and I still want to see the profits of each partner. But these contributions are limited to whatever was said in the partnership agreement. Remember, the partnership agreement stipulated exactly how much capital each and every partner should give. So it's not like in a sole trader where he can put some money in and next month take some money out through drawings. They're not allowed to do that. Every time if they want to take out some of their contributions, they need to go and rewrite the entire partnership agreement. So that's not practical. So what they then did was to say, instead of having one account called capital for both the contributions and the profits, they said, let's split it up. Let's make one account for the contributions that can keep only the contributions, and then one account for the profits that can show each partner what is the profits that they are earning every year. And that's why when you go to the ownership equity accounts, we can see there's a capital account as well as a current account. So now you can guess for yourself what is the purpose or the role of each of these accounts. Obviously, the capital is then there for the contributions. So if I want to see how much contribution each partner has made, I go to his capital account. If I ever want to see the profit, I need to go to the current accounts. And then drawings is still the same function as always. Drawings is there to show how much money they are taking out of the business in a year. Good. And then as you can see, we now have something extra. We say it's capital of Mr. A, current of Mr. A, drawings of Mr. A. So you've guessed right. We are going to have then a capital of Mr. B, current of Mr. B, drawings of Mr. B. And if there was a third partner, we would get capital of Mr. C, current of Mr. C, drawings of Mr. C. You get the point, right? So there's a specific capital for each of my partners, a specific current account for each of my partners, and a specific drawings account for each of my partners. So this is an important difference that you need to note. Then in a sole trader, solely responsible for the debt. In a partnership, jointly and separately responsible for the debt. In a sole trader, he takes all of the profits. In a partnership, we now share the profits as determined in the partnership agreement. With this being said, let's go back to what we've done in our final accounts. So in our final accounts, everything in our final accounts looks exactly the same, except we cannot do this. We cannot say that all the net profit can just go to one person's account. So because we are not allowed to do that anymore, we now need to make another plan. And that plan says the net profits now needs to be shared. And because it needs to be shared, we need to take it to a third final account. So the third final account is the appropriation account. Appropriation, the word appropriate means to share. So when I'm sharing, that is the purpose of this account. Sharing the profits. So the net profit was calculated then in the profit and loss account. From here, I'm going to put it into my appropriation account first, and from my appropriation account, I will share it. Now remember, there's two stages of sharing. The first sharing will be the primary distribution, and the second sharing will be the final distribution. So primary distribution consists of possible three things, as we've said already. The salaries of the partners, the interest on capital, and a possible bonus. And then the final distribution belongs to the different partners. Now remember what we've said. Where do I take the profits of the owners to? We've said there's two accounts now, an extra account created. So I'm going to take it to their profit account. And their profit account has the name of current account. Current of A and current of B. The personal account of the owners. So in short, that is what you can expect from partnerships. We will again in a later video explain this all again. This is just an introduction, just to get your mind a little bit going as to what we are busy with. So back to what we've said on page number 102. We will now change the final accounts from just being a trading account and a profit and loss account. We now introduce still a trading account because we still need to have gross profit determined. Still profit and loss account because we still need to calculate net profit. But then you introduce a third account, third final account called the appropriation account. For the reason being to share the profits between my partners. Good. In the next video, we will specifically look at the new accounts that we've got. So let's go to the next video.